Welcome to the Businesstalk podcast. I'm your host Deepak from India. We are delighted to welcome Dr. Jules van Binsbergen, Lauder Professor and Anthony L. Davis Director of the Joseph H. Lauder Institute of Management and International Studies at the University of Pennsylvania as our distinguished guest for today's podcast episode. Dr. Jules is a finance scholar whose work spans both theoretical and empirical research with a strong emphasis on asset pricing. His research examines how financial markets interact with the broader macroeconomy and analyzes the structure, skill, and performance of financial intermediaries such as mutual funds. A key strength of his recent work investigates how anomalies in financial markets translate into real economic outcomes, how to accurately measure mutual fund manager skill, and how cash flow growth over time relates to the predictability of stock returns. His studies have been published in top-tier journals, including the American Economic Review, the Journal of Finance, the Journal of Financial Economics, and the Journal of Monetary Economics. Professor Binsbergen earned his PhD from the Fuqua School of Business at Duke University in 2008. He began his academic career on the faculty at Stanford Graduate School of Business, where he received tenure in 2014, and later that year he joined the Wharton School at the University of Pennsylvania. In this episode, Dr. Jules shares key insights from his research, the impact of impact investing. It's my pleasure to now welcome Dr. Jules van Binsbergen to the conversation. Dr. Binsbergen, we are truly honored that you have accepted our invitation and delighted to have you with us today.
It is wonderful to be here, Deepak. Thank you so much for inviting me. As you know, I have a podcast of myself, All Else Equal. So it's quite nice to be in the other seat for once and to not be the host, but to be the person who's being interviewed. So thank you so much for having me.
Thank you. Professor, to start, what motivated you and your co-author to revisit the core question of whether impact investing and ESG divestment can truly change real economic outcomes for firms?
Well, so I think that for the longest time, I think people were assuming that divestment strategies, which is the idea that if you decide to no longer invest in a company because you think that that company is doing something that you don't like, that will lead to a change in the behavior of that company. I think that there was this assumption with a lot of people that that would work. And we were always wondering to what extent people had actually tried to calibrate or quantify or measure the extent to which that statement was actually true. Because, there are many things in the world that sound intuitive and that sound that they will work. But to actually prove that quantitatively or empirically they do work is quite another statement, particularly in an equilibrium setting. And so, the reason why we called our own podcast the All Else Equal podcast was because people often assume that things and policies and changes that they make will have the desired effects. But in many cases, if the behavior of other people is taken into account, it turns out that the net result of the system changing, not just your own action, but taking into account how all other people respond, the results may actually not be even in the direction that you thought, or maybe much smaller than you thought. And I think that that's exactly what's happening here. So the idea is that, there are lots of other people together that form an equilibrium in terms of the way that stocks are priced. And so the question is it going to have any effect if you, or even if a particular larger group of you would decide to do something, how will other investors in the market respond to this? And I think that the main insight that comes from our research is that as long as there are enough other people that are willing to start buying the stock that you are trying to sell, it's going to be quite difficult to affect the price by very much.
Professor, your paper shows that the effect of divestment on the cost of capital can be summarized with just three parameters: the share of socially conscious capital, the fraction of targeted firms, and the return correlation between targeted and other firms. Could you walk listeners through the intuition behind this simple formula?
Yes, definitely can. So I think that in fact, the first two are actually quite simple to understand. I think the third one is where most of the bite is, and it's actually quite interesting what's going on there. So first, I don't think that many people will be surprised that, if there's one investor who manages or invests $10,000, if they would be the only one who would be trying to affect the behavior of firms by divesting, that is not going to make much of a difference. And so if you want to get some effect on the cost of capital, you need quite a lot of coordination with a lot of investors and get a lot of available wealth to coordinate on which companies we should exclude versus which companies we can keep. So that's that first input parameter. And so the fraction of wealth that socially conscious investors hold is therefore a very intuitive and clear parameter that affects the effect on the cost of capital. So that's one. The second one is the fraction of targeted firms is going to matter a lot, because if that group of people would decide to target quite a large part of the firms, that will have a larger effect than if there's just one firm that is a particular group of investors would target. Also, because there are always also these other investors that can always pick up the slack and can buy the stock if they believe that that stock is undervalued if other people are selling it. I think the one that was the most interesting and the most surprising to us is the last one, which is the correlation. And so the way to think about it, the easiest way to think about it is the following. Suppose that we have an economy and there are two goods in the economy, apples and pears. And everybody consumes apples and pears. And we have 50 consumers that consume apples and 50 consumers that consume pears. Sorry, I said that wrong. So suppose that we have, after people become socially conscious, we have 50 consumers that say, oh, you know what? I no longer want to consume apples. Apples is not for me. I just want to consume pears. Now, as you can imagine, the price effect that you're going to have is very much going to depend on what the other consumers, how they feel about this. Suppose that the other consumers said, you know what? We don't really care whether we consume apples or pears. So we were before eating both apples and pears. But now, if all the others want to eat the apples, let them have the apples. We're perfectly happy eating the pears, because whether or not we eat apples or pears doesn't really matter to us. And so if that's their attitude, it's going to be very difficult to move the relative price of apples and pears. Now, if the people that are not saying we don't longer want to eat apples would say, actually, we don't like it that we're being forced to not only eat the pears, we also want to eat the apples, and they're unwilling to substitute away, as it's called, from the apples, you can easily imagine that the price of apples in that case is going to be affected. And so the correlation coefficient in that formula is actually playing exactly that role. So the correlation in that formula is going to tell you how much people care about the dirty versus the clean stocks. The people that are asked to hold both of those, do they really care? And if the correlation coefficient is really high, that's exactly the same as saying, you know, that group of people doesn't really care whether they eat apples or pears. They're perfectly happy doing either. If the correlation is low, then people are going to say, hey, wait a second, I don't want to hold all of these other firms. And so therefore the effect is going to be much bigger. And so as it turns out, if you have two diversified portfolios of clean and dirty stocks, then the correlation between these two portfolios is really high, which is another way of saying that to the group of people that aren't the clean investors, they don't really care whether they should hold the dirty or the clean stocks. They're perfectly happy to hold either of the two, and therefore affecting the price is going to be very difficult. And then by implications, changing the cost of capital is going to be pretty difficult. And so there you have all the three ingredients, which is one, the amount of conscious capital, which is very intuitive, the fraction of firms that you target, which is very intuitive. And then this last one, once you get it, I think it's pretty intuitive too. It's a measure of how substitutable clean and dirty stocks are for each other. If they're extremely substitutable, it's going to be really difficult to affect the price.
Professor, when you calibrate the model to current US market data, you find that the change in the cost of capital for dirty firms is less than 1 basis point. Why is this effect so small in practice, and what does that imply for capital budgeting decisions inside firms?
So first, if we take those three inputs that we have in the formula, right, and we plug in reasonable estimates for them, then if you just multiply them out, you get to the result that you just mentioned. And part of that is that there's still the amount of socially conscious capital that's employed in the US is still not particularly large. That's one. Two, there's this fraction of firms that are targeted, which is about 27%. But most importantly, that substitution that we talked about earlier, the correlation coefficient between the clean and the dirty stocks is just so high and north of 0.9 that for that reason, it's very difficult to make the cost of capital change by a lot. And therefore, if you plug in reasonably calibrated numbers, then you get to this very low number for the effect on the cost of capital. But let's also say that we are definitely open, and we did that in the paper, to exploring how much conscious capital really is being employed, right? And so there are multiple measures out there in the literature, and different people use different input numbers. But even if we put in more aggressive numbers for how much socially conscious capital there is, suppose it's not 2%, but it's 30% or even higher numbers, it's still going to be very difficult to get a substantial change in the cost of capital. Now, when firms make their investment decisions, they use this cost of capital to compute the net present value of their investment opportunities. And I think that we sort of, and we acknowledge that there's a bit of an arbitrariness to this choice, but we said, well, suppose that you wanted to affect the cost of capital by 1%, because we think that that is at least a number that people would pay attention to if the cost of capital would change by that much. And we just show that with the current numbers that are in the data, it seems very difficult to achieve such a 1% change in the cost of capital. If the cost of capital is changing by much less than that, it seems very hard for us to imagine that in a capital budgeting decision inside a firm, people would really change their behavior if the quantitative effect is that small.
Professor, you used the FTSE USA for Good Select Index and the Vanguard FTSE Social Index Fund as a key empirical settings. How does this setup allow you to isolate the impact of ESG-related divestment on firms' cost of capital?
So we chose this index because Vanguard, which is one of the largest, if not the largest asset manager in the world, right, together with BlackRock, and they have decided to base one of their socially conscious index funds on this FTSE for Good index. And so what we were looking for is that if FTSE for Good would decide that a firm is included or excluded, meaning that now the criteria are met for it being a good firm or socially conscious firm versus a non-socially conscious firm, once we see that inclusion or exclusion happening, we would like to measure what the price impact is of such a decision. Because if people really thought that labeling firms as dirty firms and therefore people no longer wanting to invest in them would really have a meaningful effect, shouldn't we then be able to see that a reclassification decision should meaningfully change the price of the firm? And so we looked at these inclusions and exclusions and found that it's almost indetectable in the data what happens to the price, even in months around this inclusion decision. It's very difficult to find any meaningfully large effect. And that seems to be consistent with the theory part of the paper that we talked about earlier, when you just have these three simple inputs to the formula, and we found these very small changes to the cost of capital. The cost of capital is the same as the discount rate by which you discount the cash flows. And so if there's no change in that, we shouldn't expect to see large changes in the price. And indeed, when we look at the inclusion and exclusion decisions, we find essentially no impact on the price.
Professor, despite the growth in ESG investing, you report that the difference in the cost of capital between targeted and non-targeted firms is statistically indistinguishable from zero. Were you surprised by this result, given this public attention around divestment campaigns?
Well, so one thing where I believe, and so this is, let's step outside of the academically published paper and let me give you some context, right? There are multiple motivations for why people are studying this topic or engaging in it. And I think that the reality of whether something works, yes or no, versus the desire of it for people wanting it to work may not be the same thing. And so that's exactly where I think that academic work and research can be so important, because in the end, we may all want something to work, but if, for example, in medicine, we may all want to cure a certain disease and may want a medicine to have the desired effect. But whether or not it does is something that scientific research will have to establish. And so we went into it with a pretty agnostic view, and that personally, I think those are the most fun papers to write, because if no serious calibration or measurement on the question is out there, or at least not a lot of it, there were a few people that have worked on trying to measure it. But then no matter what you find, it's interesting. If we had found that the effect was really large, and therefore that this strategy is an effective way of affecting the cost of capital, then that would have been an interesting paper to write as well. So in that sense, I think it's important as a researcher to not work towards a certain result and to keep an open mind and see what happens. And by picking research questions where no matter what you find, you get an interesting publishing result, that actually guarantees that you as a researcher are not working towards a result, because you can just let the data speak and see what happens. And I think that that's what happened here. And in the end, after doing all the calculations and trying to both theoretically and empirically evaluate whether or not these sorts of approaches were likely to have a real-world effect, we just came to the conclusion that it didn't. Now, there are people that say, well, this is not the reason why I'm divesting. I'm divesting because I just think that there's a moral value in and of itself to not be in a certain stock, and it just makes me feel better. And I'm fine with people making that argument for themselves, but I do think it's important to also be cognizant of the fact that we should not pretend that those people are solving the problem, right? They may feel better about it themselves, but they're not actually contributing to making the world a better place. And so let's then not at least confuse those two objectives. Right? If you want to make the world a better place in terms of, and of course, we still have to debate what better means and by whose standards and who gets to have a say in that, right? But suppose we agree on that, it does seem important to me that we figure out what the most effective ways are of then accomplishing that. And perhaps divestment, at least from all the results that we have found, may not be the best way to go about that particular question.
Professor, a striking implication of your calibration is that to move the cost of capital by more than 1% socially conscious investors would need to represent over 80% of all investable wealth. How should asset management managers and policy advocates interpret this threshold?
Well, I think that the way to interpret it is that if through divestment you want to achieve change, you need to really coordinate with a lot of people. And so let's take a step back and think about what are the various approaches that are available to address complicated societal problems, right? So, first, there are regulators that can intervene in producer or consumer markets. So, for example, when it comes to tobacco use, you can definitely tax a pack of cigarettes, make it much more expensive, and different governments have used different tax rates. There are also information campaigns where the government can intervene and start informing people about the hazardous consequences of tobacco use. Right, so that is certainly one way of approaching the problem. Recently, there is this approach that people say, well, it should be the steering power of capital. But I think that one thing is that our paper also shows, although it's not explicit in the formulas, but it's the intuition that I think is underneath it, which is the following. If a particular investment makes money, keeping investors away from it is really, really difficult, because the people that don't care about the social objective, they will find their way to the profitable investment opportunity and they will take it, and they will then still invest in it, and the activity is not going to stop. And so if water flows from the top of a mountain to the bottom of the mountain, you can try to put up as many different blockages and try to keep the water from coming down. If there are too many routes that are available, the water will find its way down no matter how much you try to intervene. And at some point, the intervention becomes so costly and so difficult that you need to wonder whether that's the best way to go about it. So keeping investors from doing profitable things, I think, is really hard. If you really want to make a difference, doing the opposite, I think, is easier, which is Suppose that there was a project or a firm or some endeavor, human endeavor, where you said, maybe this is not that profitable, but I still think it's important that it happens because I think it will really help the world. Then, of course, there are no investors that want to make money that will go after that. And so it's going to be unlikely that such a project is going to be financed unless a smaller group of people decides that despite the fact that it isn't particularly profitable to do it, they still think it's important that it happens. Now, of course, they are then giving up part of their wealth, but they are then doing that because they believe that it makes the world a better place. And so doing things that other people otherwise wouldn't have done because it isn't profitable is a much easier proposition than the other proposition, which is try to keep people away from things that make them money, particularly in a finance setting. So if you want to do the latter and you want to keep people away from doing things like tobacco, I think that you have no other choice than to get regulation and governments involved in passing laws that regulate either the production process or the consumption process. The idea that you can steer capital away from that and that that's going to be a successful way of changing the world, I think is going to be a tough sell. But again, that's my interpretation of the situation, and I think our paper is consistent with that. But I think much more research on this should be done so that various people can confirm all of these different points that I just made. I think it's important that science gets a chance to confirm or deny hypotheses that have been posed. But the hypothesis that I want to pose here is keeping money away from profitable investment opportunities through capital markets without the help or the regulation of governments that regulate product or producer or consumer markets is going to be very difficult.
Professor, the paper highlights that dirty and clean stocks are highly substitutable with correlation above 0.9 in some specifications. Why does this highly substitutability so strongly limit the power of divestment strategies?
So that comes back to how we started the conversation, right? So if I have the apples and the pears, and I start off with a situation where everybody eats apples and pears, and now suddenly part of a group of people says, we from now on only want to eat apples. Will that affect the relative price of apples and pears? Well, that very much depends on whether the other people are willing to just as well eat pears. They don't really care if the first group only wants to eat apples. And that substitutability is exactly that correlation coefficient that we talked about earlier. And so I think that the very high degree of substitutability really impedes the effect of divestment on the cost of capital and makes it very difficult to have a large effect on this. And so I think that's one of the key input parameters that leads to the result that we have.
Professor, you also stress that changing a firm's ESG status entering or existing indices like FTSE USA for good does not measurably shift its cost of capital. What does that tell us about the effectiveness of current ESG rankings and index inclusion mechanism?
Yeah, so I think that there are a number of questions that are coming to mind when you ask me that question, right? The first one is who should be devising ESG rankings, and who do we give the moral authority to make those choices? Because I think that we have arrived at a point where many different people have different objectives and different priorities. So ESG is already 3 letters. Each of the 3 letters has many subcategories. And that means that we have dozens of different priorities. And of course, dozens of different priorities is the same as no priorities at all. And so I think that we first need to make progress in terms of getting a consensus on what is the largest problem that we need to solve. To give you a particularly salient example of this, think, for example, about CO2 emissions. Suppose that we thought that CO2 emissions, because they cause global warming and therefore would form an existential threat to humanity. Of course, particularly recently, the discussion on whether that statement is true has been heavily debated, but I'm not taking a stance on that here. Suppose that we agreed that this is the thing that we need to solve. And suppose that you thought that electric cars are the key thing that can help us in achieving that goal. Then I don't think it's a smart thing to kick Tesla out of the ESG portfolio because you don't like what Elon Musk is doing, right? If the key priority is to reduce CO2 emissions, then let's focus on achieving that goal and put all our efforts towards achieving that goal and making sure that that happens. Once you start to include other objectives and other goals that potentially contradict or at least are not consistent with the goal that we just stated, then we may actually end up in a world where, because everybody's focusing on something slightly different, everybody holds less than fully diversified portfolios. But in the end, everything is still held by everybody anyway, and because nobody's coordinated on anything, and therefore we're not getting anything done. And so I think that's in some sense the worst of all worlds, because we're not getting anything done and everybody holds undiversified portfolios. What's the point of that? And so I think we first need to figure out who should be doing the rankings. What criteria does rankings based on? And I think that consensus on what the key objectives are that we want to achieve is key there. Now, again, there is the question of, and this is a question I've asked to many people, right? Why do you think that the steering power of capital should solve this problem? And one answer that I often hear is people say, well, democracy has been so disappointing in not being able to make progress on these questions that the democratic process is just, we're not going to get anything done. And therefore, the steering power of capital will have to solve these issues. But I am worried that the fact that the democratic process isn't solving these problems is trying to tell us something. If the democratic process can't solve it, that does give you a sense of how much disagreement there is over what is good and what is bad and what should we be doing or shouldn't be doing. And so the idea that you can just short circuit the democratic process and then through other institutions that weren't designed to answer these very hard questions, for example, capital markets or financial markets, that suddenly we can solve these very hard problems that way, I think it brings a whole set of issues with it in and of itself that we should carefully think about.
Professor, one of your main conclusions is that if socially conscious investors want real impact, they should invest and use their control rights rather than divest. Can you explain how this voice rather than exit approach might work in practice?
Yeah, so the first question is, suppose I think a company is not doing what I want because they are polluting or they're doing something else that I don't like. And suppose I care about that, right? Is then the best response for me to say, because I care about it, I'm going to sell my shares to somebody who doesn't care about it? Meaning now the only thing that happens is the ownership of the firm changes from somebody who cares about it to somebody who doesn't care about it, which means that the probability of the issue being brought up in the shareholder meeting has just gone down, not gone up. And so I think that in choosing to give up your voice in an organization when you were given an official path to have a voice, which is your owning of the shares, I think you should be very careful about that before you do that. Now, there are many shareholder proposals that are close votes. And so if you wanted to push through a particular vote that was otherwise a close vote, having a substantial ownership share to try to get that voted through might be more effective. Now, between you and me, the evidence on this, in terms of how effective that is also mixed, right? Meaning that some people find modest effects, some people find small effects. At least there is some evidence that there are effects. With the cost of capital, I think the argument is going to be much harder to show that the effects are going to be meaningful. And I don't think that we are seeing the behavior of firms meaningfully change because of these divestment initiatives. And so therefore, if I had to choose at this point, while both have their challenges and a lot more research needs to be done on both paths, if you made me choose right now which one of the two I would pick, I would probably go for engagement over divestment.
Professor, I would like to conclude this episode with one last question. Looking ahead, are there any possible scenarios such as regulatory changes, much larger ESG participation, or different market structures under which divestment could become a more powerful tool? Or is it influence fundamentally limited by the mechanism you document?
Well, so I think it's tough. So let me tell you the story about the whales, right? And this is partly a fairy tale, partly true. And so, but I think it tells the story perfectly, right? So a couple hundred years ago, or maybe 150 years ago or so, whales were about to go extinct. right? And the reason why whales were about to go extinct was because people were lighting their houses with whale oil and because people were using the oil for soap. Now, suppose that you wanted to save the whales. What would be the most effective way to do that? Now, there are a bunch of different options that are available that you could try out. One is to tell people to stop washing themselves and to stop lighting their houses. It seems very unlikely that even with lots of campaigning, people would change their behavior if there is that fundamental need for lighting their houses and washing themselves. So while you can try that social pressure approach, the question is whether that will be very effective. Right? The second strategy that you could do is to say, from now on, whale hunting is illegal. But unless you address the underlying demand for both the whale oil, for the lighting the houses and washing people washing themselves is not addressed, then even that regulation is going to hit quite some roadblocks because there will be a black market where these products are going to be sold anyway. And so it's going to be still very difficult to change. Although, of course, now at least there are criminal penalties on doing the whale hunting, and that will at least complicate the whale hunting and slow it down somewhat. But to say that this is a total victory is still going to be very tough. Now, the third option would be to say, suppose that there are whale hunting company shares, and you would say everybody should just sell their shares. Now, we already discussed earlier in this podcast that trying to get the price to change is very difficult as long as there are people that want to buy the shares. Let me give you one particular salient example of that, which doesn't even have to be in public markets. Suppose that you did manage to drive the stock price of the whale hunting company all the way down to close to zero, say for 1 cent. Then, often I ask my students and they say, what do you think is going to happen? And then they say, well, the company will just cease to exist. I say, are you sure about that? And of course, the reason is, essentially, you now give the CEO of the whale hunting company the opportunity to buy all the shares of the whale hunting company at a bargain price. They can simply buy it for 1 cent a share. They buy up the entire company, and therefore you give them the biggest gift of their lives. Meaning the person that cares the least about the fate of the whales is going to be incredibly rich by the strategy that you just employed, because they buy up all the shares, own the company, take it private, and collect all the profits from the firm from that point forward. So in the end, what was the solution? It was that different types of oil became available that were cheaper than whale oil. And through that technological innovation, whale oil as a product was very quickly competed out of the market, and therefore the whale hunting stopped and the whales were saved, because this other way of getting oil was cheaper and more economically profitable. And for that reason, there was a natural incentive for people to stop hunting the whales, and no other intervention was necessary to achieve the objective. And so I think that this story has important implications for how we should think about a lot of the large-scale problems that we're currently facing, and what are the most effective ways in trying to address these problems and how to move forward with them.
Dr. Jules van Binsbergen, thank you so much for joining us today on Business Talk. Your research on impact investing offers such a critical perspective on how we measure and achieve real change through financial markets. The distinction you draw between divestment and active engagement, between exit and voice, is both intellectually rigorous and practically important for investors and policymakers alike. We are grateful for your time, your clarity, and your commitment to advancing our understanding of these crucial questions. For our listeners interested in exploring this research further, we will share the links to your work and the Lauder Institute in our podcast notes. Thank you, Dr. Binsbergen. It's a truly pleasure having you with us today.
Thank you so much for having me, Deepak. It was great. Thank you.